Hey everybody, welcome to Trading Capital's Market Analysis and Insights. Diving into the major indices and sectors, we're going to touch base on what has transpired last week and what we foresee next week and the key technical levels that we need to be aware of. So jumping into the S&P 500 here, clearly on Friday we had a massive down day in the markets. The S&P was down 1.64%. And the Nasdaq was down just over 2.5%, 2.67%. So lots of sell pressure. Essentially, the stocks that were hit was big cap tech. All of the major sectors on Friday closed in the negative, in the red, except for really energy, lumber, the US dollar, and that's pretty much it. So with big cap getting hit really hard on Friday, it obviously brought down the major indices significantly. And here we see that the S&P had the strong rally and then it gapped down into your pre-market trading. And essentially the selling just continued until you found a bottom just late in the morning. And then you had a little bit of a rally up, but then you sold off again. So why did the markets gap down? We had some positive economic news that the markets received on Friday, which was the jobs number. And essentially the jobs number showed that there was positive economic data in the sense that the job creations were higher than expected. So I believe they came in at roughly 360,000, a little more than that. And the markets were expecting around the 300,000 mark. So with the markets getting a better than expected job number, many people would think that that's a positive catalyst for the markets. However, when you have to factor in why the markets took the positive economic data in such a bad way, simply for one fact, when you break it down, it's because the Federal Reserve has two mandates. They have to focus on inflation or unemployment. And right now, they're focusing on inflation. So since the jobs number came in better than expected, and since our unemployment numbers in the States are roughly still at 3.6%, which is very low historically speaking, it still gives the Fed the ability to put all of their attention and might on focusing on their one mandate of inflation and disregarding the other mandate of maximizing employment. So since employment is still upticking and unemployment is still historically low, it gives the ability of the Fed to continue to hike aggressively and accelerate their quantitative tightening plan. So that's kind of what the markets anticipated. And notice what stocks were hit the most. All of your big cap tech stocks. So those are your essentially your most institutional stocks over the last decade have been your big cap tech plays. And that's the smart money now dumping their big cap tech and slowly reducing their exposure due to the fact that they believe the Fed is now going to continue to be more aggressive since the jobs number came in higher than expected and since it shows that the economy, when you use the unemployment metric, is still stronger than expected. And notice this tight range of selling again. This tight range of selling all the way down, we've seen this multiple times. This is clearly institutions unloading key amounts of their positions into the open market, most likely dumping into retail traders. So this technically on an intraday basis is not a good pattern. It is a little bit of a bearish pattern, so to speak. However, when you flip to the daily chart in the S&P, which we'll take a look at right now. So let me just turn on my volume candle. So when we look at the S&P 500 here, you still have this bullish daily chart pattern. And one of the reasons why this is still a bullish pattern is because you're trading inside of this last impulse candle to the upside. So as long as you ping pong and consolidate in this range, it does favor that you can make a move up to the next resistance level, which will be roughly over here. And this is a key technical gap fill at this 428 mark. Notice how you closed at the high here and you gap down all the way over here. So this will be a key resistance level, and should you be able to make a run up for that high, that will be a very, very interesting level to start shorting the big indexes. And that's certainly what we're going to look to play. So as long as you keep this bullish type flag pattern consolidating maybe for a couple days, it does favor a short-term move to the upside up to this 429, 428 level. And we will have to monitor it from that point. I don't think the markets have enough strength to get past this 428 level, but certainly there's a possibility that it can get up to that level. Now, if we start to break this bull flag pattern down, the markets can fall very, very quickly. You do have a key gap fill here at this 405 level. Now, the thing about gaps, they're not all created equal, and since you are consolidating above this gap, don't expect this gap here to be major support. You'll most likely slice through this gap support very, very easily if this flag pattern breaks down. You do have another secondary gap down here, which will be a little more support since it is lower on the chart. However, again, if you start breaking those levels, it does favor a move down to the lower range of this channel. And notice how the volume has been extremely light. We had 71 million shares trade on Friday. There is a declining volume trend. That's not really a good sign for the markets. When you have light volume, it does favor the markets to float up. And considering the volume was extremely light on Friday, and we still saw a major downward move, that is not a good short-term indicator for the overall strength in the markets. But nonetheless, we'll have to monitor this consolidation. If we continue to consolidate sideways in this green bar, then it does favor a move up. But if the pattern gets long in the teeth and you start breaking down, look for a move to the lower end of this range very, very quickly. Now, one of the key things I want you to be aware of. So when we take a look at the lower highs that we're making. So we had our high here, which is 1. We had another lower high here, which is 2. We had another lower high here, which is 3. And now we're making this 4th lower high. And we don't know where that lower high is going to start rolling over. It could be here. It could be up here. But we'll just have to monitor, because this is essentially, once this pattern starts to roll over, it is going to be our 4th lower high on the charts. And one of the reasons I'm bringing this to your attention is if we scroll back all the way to the 2008 cycle, and let my charts just adjust here. Just bear with me while I scroll all the way back to the 2008 cycle. My charts just need some time to catch up. So remember that we're on the 4th lower high. We've made 3 lower highs in the S&P 500. And we're looking to make a 4th lower high once this pattern starts to roll over again. So just keep that in mind. We're on the 4th lower high, but going back to the 2008 GFC subprime crisis, if we take a look at the S&P 500 here, just give my chart a second to load. It will load here in a second. It's just pulling the long-term data. So notice how here on the S&P 500, this is the 2007-2008 collapse. So notice how we made a top in the S&P. So here's your first high, here's your second lower high, here's your third lower high, and here's your 4th lower high. And what preceded the 4th lower high was one of the worst crashes in the stock market. So we've made 4 lower highs and the stock market crashed. If we go to the 2000 dot-com cycle, it's really incredible how these cycles align to a T. And that's the power of technical analysis, because human emotion does not change. Sure, the crisis changed, the debt levels changed, the monetary and fiscal policy changed, but human emotions, greed and fear, never changes in market cycles. And if we look at the 2000 cycles, let's just let this chart load. It's the only downside about going so far back in time is it takes a little bit of time for the charts to load, the data, but nonetheless we're getting there. So we're almost there. S&P 500. Let's just load here for a second. Here we are. So we're in the 2000 dot-com cycle. So notice here we had our first our high here, 1 high, second lower high, third lower high, and this was your 4th series of lower highs. And then you had a massive collapse, which was the dot-com bust. So the trend is that every time in the last two stock market collapses, the dot-com bubble and the GFC crisis, we made 4 lower highs and the stock market collapsed. Same thing in 2008, 4 lower highs and the stock market collapsed. So that is really interesting in my opinion as a technical analyst, is we've made 3, we're onto our 4th one now. It stands to suggest that if the market follows the same cycle as the previous 2 massive declines in the year 2008 and the year 2000, then there's a strong probability that this could be the last lower high before the markets see a significant downturn. Whether it's a crash, whether it's just a consistent, another 6-7 weeks of downward selling, there's a lot of weight that you have to hold in terms of previous cycle analysis and the patterns that markets form over time. So I'm very, very defensive at the moment with our positions. We still have some long positions on the table, but we are net short the market at this point in time. So I'm feeling a little more confident in the sense that if we do get that crash, we will profit tremendously. And I'm certainly thinking that there is a strong base case for a market crash due to the fact that the crashes don't happen at the high point of the markets and they don't happen at the low point. They generally happen at the middle vicinity of the markets, and we're kind of in that middle point of the markets. And if we did get some sort of crash, where do I think we would go? Well, you'll have tons of support at this 338 level, but I do think in a market crash, you cut through that. You'll have your secondary support lines down here. But ultimately, I think I'll be comfortable going long and starting to accumulate positions in the center point of this channel and then at the low range of this original channel before all of the QE commenced. So that's something we're going to have to keep in mind. And just remember, we haven't even hit the pre-COVID levels before the money printing was started. So in order for us to pretty much wipe out the whole stock market bubble that was created with this massive influx of money printing, we would have to at the minimum come to this 339.22 level. And if the economy gets really bad and we do have a recession and a stock market crash, there's a strong chance that we slice through that level and we slice through this level with ease. So just keep that in mind. It's interesting to see if that'll play out in terms of the same cycle as the previous 2008 crash and the 2000 cycle, but it really should be eye-opening, and people should be using the technicals and the patterns and the previous cycles as potentially a guide. Now, you can't predict a crash. I'm not saying that there's a guaranteed crash that's occurring, but it's just little patterns like this that can cause you to position yourself in a more defensive way, because ultimately, do I think these markets are going to rally and make new all-time highs? Absolutely not. Not unless the Fed pivots and starts printing excessive amounts of money again, which I don't think they're going to do until unemployment starts to spike and inflation is down. If we take a look at the Nasdaq is putting in some bullish consolidation to move higher. You also have a key technical gap fill at this 13,549 level, which if this pattern breaks the upside, you do have a strong probability of getting up there. If this pattern breaks the downside, again, you have a technical gap fill here, which is not going to hold much support due to the fact that you are consolidating above it. If you break that key technical gap fill, then ultimately I do think you test the low range of this channel again. Taking a look at gold, gold is interesting. Gold has been holding up pretty well. You did have a nasty reversal candle on Friday, which it didn't negate the full up move on the Thursday move, but nonetheless it was a pretty strong, powerful reversal. And one of the reasons we've seen gold reverse is just due to the fact that the US dollar, so the UUP here, or the DXY, the UUP had a pretty strong positive day on Friday, which inevitably put pressure on gold since they do correlate. They have a high correlation in the way they trade. And I think that's slowly going to change over time, just due to the fact that we're starting to see currencies worldwide start to collapse. And as currencies around the world start to collapse, it will inevitably make the US dollar stronger, because people will look to leave that currency that is collapsing and move to a more secure fiat currency that has a little more stability, like the US dollar. And since the US economy is still the biggest in the world, it does have the best shot at repaying its debts, despite it mathematically still being impossible, which I find very, very ironic, just in my opinion. And one of the reasons I think gold has also been under pressure is if you look at the US 10-year yield here, you've had 1, 2, 3, 4, 5 positive days in a row. This is also one of the factors that the markets have also been under pressure in terms of big cap tech. Once you've had yields push up 5 days in a row, almost to that 3% mark, it's naturally going to turn the environment to a more risk-off environment. But I do think it's interesting that when you look at this parallel channel that the yields have been trading in, notice how the power of yields, they were pretty much trading in the upper range of this parallel channel, and then you broke down and you pierced that channel, confirmed below it, and now you've rallied back up, you've retraced to where you broke down. But notice how this parallel channel is acting as major resistance. So I still think yields will move lower, roughly to this 2.48 mark over here, before they start to make a move up. So it could be potentially a pattern of, say, of this magnitude, and then another move all the way up to around the, potentially the 4 or 5% mark. So that's going to be a tremendous amount of pressure on the overall economy. I do think the Federal Reserve continues to hike. We should see a new Fed fund rate hike in the middle of the month, which will certainly cause a little bit more volatility in the markets. Next week is going to be pretty crucial for the markets. I do think we can get a little bit of a move up, but don't think this rally is going to last long. It's certainly a rally that you want to sell into and not get sucked in by buying. The time to buy this rally was down here, which is what we were doing. We were dollar cost averaging into positions, caught a bounce. We've unloaded a tremendous amount of our longs, and we're starting to accumulate short positions. If we take a look at Bitcoin, Bitcoin's interesting because if we look at the overall longer term pattern, we had this bear flag pattern which we were monitoring for months. It broke down perfectly on a technical basis, and now you've had this massive sell-off. You had a quick rebound from this 25,000 level up into the 31,000, 32,000 level, and then you were trading in this wedge pattern for a couple weeks, and you broke out of this wedge pattern. You had a nasty reversal candle back down, retraced to where you broke out of this wedge pattern, which is just an amazing technical picture. When you have a breakout, it's often you retrace back to where you broke out of. So that's exactly what has happened. And now you're still trading above this wedge pattern. But the question is, Bitcoin needs to make a move sooner rather than later, because this little bit of a reversal candle can turn into a mini micro bear flag pattern, which will ultimately cause it to break lower. But I still do in the short term, because you have this massive reversal wick over here, it still favors a move up to about this, I would say the 34,000 mark at the high end if we get up there. Another parallel channel that I want to bring to your awareness is if we erase this channel over there, and we take this parallel channel and we bring it all the way over here, and we pull it up here. So notice how this is a beautiful parallel channel. Let me just erase that. So this is kind of the new channel that we're trading in. You can see we hit it high here, pulled off, kissed it, floundering in the center point of the channel, kissed the low range of this channel, hit the top end, and then now we're trading in the center point of this channel. I do think there's a possibility that we head to the top of this channel. At the high end, that would be the max target for Bitcoin, but I do think we can conservatively say Bitcoin has a strong probability of getting to this 34,000 level. We will certainly be looking to unload our long positions on Bitcoin around that level. Notice how our average is right on this dotted green line, around 30,287-ish. And it'll certainly be interesting to see if Bitcoin can get some momentum under it. If Bitcoin rallies to our level, that'll be a nice 13.4% gain in our pocket. We'll just have to monitor Bitcoin as it is. One of the things I do like about Bitcoin is the fact that you did have this initial breakout impulse move, and then you had this reversal candle. The interesting thing about this reversal candle is that you did not reverse all of the gains on this impulse candle. So had you pretty much reversed all of the gains on this initial breakout candle, that would have made me very skeptical that Bitcoin is going to head much, much lower very, very quickly. So since you did not completely engulf and negate this full breakout candle, there is still some positive bias that Bitcoin should break higher in the near term. And I think due to the fact that yields have popped over the last week or two, it has put pressure on the risk on assets. Sorry, the risk off assets. If we take a look at oil, oil's really interesting. It has had a tremendous move up. If we flip to the daily chart here, you can see oil's trying to break out again. We did have this trend line over here that we were watching for quite some time. You have broken out above that. It does look like you want to test the double top here for oil. I'm still in the camp that we're heading into recession. Gasoline prices have gone ridiculously sky high. Yes, we have a war, but we've had tremendous wars throughout history where it's caused oil to spike. We had a war in 2008. We had a recession in 2008. We had a high energy price in 2008. We had war in 2000. We had high energy price in 2000. We had a recession. We had a collapse in 2000. In the 80s, we had wars. We had embargoes. In the 70s, we had wars, embargoes, and high energy prices. And it all led to the same thing, a massive collapse in energies, which signified a major recession. And I do think that's where we're heading. I don't think it's a matter of if, I think it's a matter of when. And I'm still in the camp that we see this recession in 2022. July 15th, in my opinion, is going to be a tremendous point in economic history, because I do think that's when we get that technical recession. July 15th is not only when we get the Q2 US GDP numbers, but it also happens to be a Federal Reserve meeting, an FOMC meeting. So just let that sink in. July 15th, we could clearly get the data that shows we're in a technical recession, and then we're followed up by an FOMC meeting. So lucky us. So we'll just have to monitor the price action as we go. I do think the markets can chop a little bit for the first couple days of the week before potentially making a move higher. But if we break this pattern, look out. We could potentially start the next down leg in this cycle. So stay tuned for more updates and more trade alerts, and we'll continue to potentially position ourselves on the right side of the market. Thank you everybody for subscribing and being members.